Welcome to TheoTrade. This is Don Kaufman, April 24th, 2020, doing the weekend update here on a Friday afternoon, just a few minutes after the cash close of the marketplace. Listen, we're going to talk quite a bit about this past week of trade, but, well, much more importantly, we're going to be looking forward. And we're going to be looking forward because we expect this next week to be a very pivotal week inside of the markets. And to try to answer the bigger question here, are markets approaching a breaking point? And why do I say that? Well, let's start with this. Before we really look at some charts, some trade ideas, okay? The economic blows, it just keeps coming out there. Earnings, they've been brutal thus far. All right, guidance has been pulled. I mean, that's one thing that almost every firm in the S&P 500 that has reported thus far has actually talked about is we're pulling guidance, lowering guidance. And if you look at a company like Intel, which actually had its earnings last night, the stock had actually gapped considerably lower. In fact, I'm showing you here the intraday chart. Stock gap lower and rallied back up throughout the course of the day. And again, you start, looking at this time and again, start shaking your head. So let's push aside earnings. We're going to talk about that again more in just a few minutes. But we're looking at 20% unemployment minimum with another, 4.4 million jobless claims this week. That puts that number, people, in the upper 20 million range, which again comes out to about 20% unemployment. The unemployment numbers, you're going to have to wait just over another week for those unemployment numbers to effectively come out. Nevertheless, PMI crashes around the world. If you saw some of the PMI numbers, they were hideous is not even the right word, but they had PMI that was almost in single digits inside of France, which is, for the most part, you're saying zero, activity inside of the economy. Again, I can go on for a half an hour about that, but you get it, right? Earnings are brutal, 20% unemployment, PMI crashes, 6.4% of mortgages, have actually come into this new program. And the new program, what does it effectively do? It kind of says, all right, you don't have to pay your mortgage for a couple of months, but quite frankly, there isn't that much clarity around some of the mortgage programs, and they differ from bank to bank. One thing, though, that we do know is that there's $764 billion of unpaid principal that does not include some of the interest. And in some of these programs, they actually tack the interest and tack the payments to the end of the note. Confusing to say the least. But they added, again, literally, hundreds of thousands of more just this week. So we're up to 6.4% of mortgages are actually in kind of this delayed program. The reason I'm actually throwing a little bit more weight towards that, because throughout the course of the past few weeks, even I myself have been comparing this a little bit to the financial crisis. People, we are way beyond. Earnings, come on. Earnings were nothing like this during the financial crisis. This is just absolutely dismal. 20% unemployment, hasn't happened since the Depression. PMIs, we're getting numbers that don't even really resonate because they're that low. And the mortgages. The mortgages, we've actually surpassed where we were, and we're only, 5-6 weeks into this. The durable goods came out today. It was actually minus 14.4%. Which was significantly less than expected. And then last but not least, and I thought this was an interesting one because I think a lot of people missed it. I could talk about earnings here and there. This wasn't earnings. This was just Google. This was just Google came out and they actually slashed their marketing budget, and they actually put they're freezing all hiring. But I thought it was interesting because they slashed the marketing budget by 50%, which is absolutely massive inside of a firm like Google. That marketing budget, that alone is going to reverberate through the entire, marketing industry, tech industry. And if Google does it, believe me, there's more firms to come. All of that, by the way, I wanted to show you here specifically in Google. Google dropped at the open and actually rallied into the close. And, I'll talk about this more, but you kind of look at this and you go, is this, are we in denial right now? And I think that's a fair question to actually ask. And I'm already going to rip right down to it. And the Nasdaq, with all of this going on, do you know the Nasdaq? And I'm just going to highlight it on your screen for right here. This happens to be the QQQ, which is the Nasdaq, and it's down on a year-to-date, basis. Right there, the tune of about 1%. So the Nasdaq is massively unchanged on the year, with everything that I just discussed above. So, by the way, the Nasdaq, I know that often we think of it's just tech companies, Don. It's tech companies. It's not just tech companies, and that's why I asked the question, are markets approaching a breaking point? Okay, denial? Yeah, clearly to a degree they are in denial. So let's actually move into let's start actually in the spiders. Let's start in the spiders, then we'll kind of continue along a couple of bullet points in here. And the reason that I wanted to start inside of the spiders, okay, we have a really unusual circumstance kind of evolving in here, and you have to speak a little bit of trader geek to kind of get this, and I'm going to try to break it down for you the best I possibly can. All right, a few things that I see that are real standouts here, okay, and I think that you can really see all of this by, well, simply just looking at the spiders. One of the first things I'm going to start with, okay, obviously, markets fell, wow, rather substantially, okay? And throughout the course of the month of March was hideous. And then we've had this, effective, rally back to the upside to a degree. But over the last about 2.5 weeks, we have been utterly, completely, and totally flat. And we've been doing that, okay, on less and less volume. Volume is hideous. That's actually why I initially brought it up over here. So let me go ahead and close up this left side bar. Again, we're just about 30 minutes after the cash close. You can see the future is still moving around. But the point that I want to get into here is that you just don't have a lot of involvement inside of this marketplace. And I want to open up a broader chart. I'm actually going to knock this thing out all the way to a 3-year time frame. And I want to highlight once again for a second where the volume happens to be today. Okay, so, and again, we're still in a relatively high VIX, right? And I wanted to show you where the volume is today. And you can see, like, wow, that volume, it's, is it above average? Yeah, you can make the argument that the volume is slightly above average, but never, okay, have we seen volume this light in a 35 or 36 VIX. Now, speaking of the VIX, and I'm just going to pull that back up for a second. If you look at the VIX, all right, well, the VIX it came off a lot today. 36 kind of handle inside of the VIX. All right, but let's go back to the spiders for a second. And why am I even bothering, discussing the VIX? Okay, one of the unusual circumstances that we're in right here, right now, we have an incredibly tight channel of trade. Now, this has now been persistent for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 trading sessions. Now, you've had 11 trading sessions. You can't see the candles now, but you've had 11 trading sessions inside an incredibly tight range. So what we're getting at this point, trading firms, retail clients, they continue to allocate capital. As you continue to allocate capital, okay, more and more capital kind of just continues to grow risk and grow risk and grow risk in a tighter and tighter standard deviation. Now, some of you that might look at things like Bollinger Bands, and the Bollinger Bands, they get really tight like this, okay, and then all of a sudden, boom, everything explodes in your face. But I'm going to explain it a vastly different means, okay? So I'll put this little box around it once again. And again, very, as I was saying, very tight range that we have been in this past 11 days. And you're like, okay, whatever. I've seen ranges before. Yeah, but the unusual portion of this is there's IV, okay, and then there's HV. And the IV is the implied volatility. That's what's derived from options. And the IV in this case, okay, up here was in the mid 40s or so, but IV right now is still at like 36%, which indicates that you should be a rockin', right? Now, the historical volatility, which is actual price movement in the market, what's interesting about it is that's completely dried up. So if we come over here to the studies, all right, and well, you know what? I'm going to knock volume off here first. Under equities, get rid of the volume subgraph, hit apply, hit OK. Then we come over here to studies. We go add study. We come down to volatility studies. We look for historical volatility, which is the annualized standard deviation of past stock price movement. But you know what? I don't want to see historical volatility over the last 20 days. I actually want to right click, come over here to edit study. I want to knock that down, okay, to a tighter time frame. Just bear with me for a second. Calm down. Let's knock down the length to the last 5 days. Hit apply, hit OK. And I want you to see things are getting interesting right now. So the historical volatility was just rocking back here when the VIX was a lot higher. But look, historical volatility over the past couple of days, and it is actually pulled back, interestingly enough, okay, to almost right where the volatility happens to be. Okay, so historical volatility has now come back down kind of where the VIX is. The interesting thing, and most people miss this, but historical volatility was far exceeding implied volatility for quite some time. Well, now the two have actually come to an agreement. And at this point in time, I will definitely caution you. We are wound up, people, like a top. There's a lot of risk in this marketplace. And I want to box this out for you really quick because I've been talking about this, considerable amount. Okay. We're going to crack this range. When we do, things are going to get a little crazy. That range, look for the spiders. Okay, 290, 270 is the range. Cracking through it is going to mean, again, a very substantial move inside of the marketplace. Now, with all of that being said, you're like, great, which way are we going to go? Well, that's exactly what we're about to discuss, all right? Nevertheless, I'm going to tell you right off the bat, okay, you can be wrong in this. You think what you will about all the economic data that has come out over here. Obviously, we're going to discuss Fed and Fed stimulus here momentarily, and that could be enough. That Fed stimulus could be enough to pop this market back to the upside. And you're like, but, so what am I? I'm going to tell you exactly what I am in my positions right now. It doesn't matter about your positions here. This is, again, I put my money where my mouth is. I'm going to tell you exactly what my positions happen to be. So I've actually created a position, once again, that is negative delta, which effectively means, okay, am I all bared up? Nah. I mean, I've got pretty good bearish positions on, but I have bearish positions, which means, in effect, I want the marketplace to go back down. But I'm going to be very clear about this. I'm not bearish in the spiders. I've taken target practice this time, and I've actually built some bearish positions in a handful of tech companies, like a Microsoft, like an Intel. Okay, I'm back into a bearish position inside of Caterpillar, and it goes on, and I've got bearish positions inside of a couple of consumer staple stocks because I believe that they've actually rebounded quite considerably. So net, I'm sitting on negative delta, but at the exact same time, okay, I got a little nervous and I went over to the Russell, which is the IWM, and I built a couple of back ratios just in case we explode back to the upside. And I'm just telling you, that's what my position kind of reeks of right now. So here inside of the IWM, all right, I built a number of different positions, okay, in here. And again, you can see some of the back ratios that I've actually got on that are effectively partially in the money already. All right, and why am I building these? Just in case. So these back ratios are done for a very, very small credit. Again, a very small credit. So what's going to happen is if the market were to explode to the upside, my P&L, okay, will actually explode to the upside inside of the IWM, but I'll lose in positions like Microsoft and I'll lose in positions like the Caterpillar position. However, okay, in the IWM with this back ratio, okay, if the marketplace tanks, do I lose money in the IWM position? No, because I took in about a 40-cent credit for the position. So, I'm not out there. I want you guys to understand that right now, all right, I'm looking at the marketplace probably the same way you guys are. I'm looking at it and going, come on, look at this data. We're all doing the same thing. Look at the data. The data, how do I say this eloquently, sucks, and yet the marketplace is holding up. Okay. And I love the rationales, by the way. I really love some of the rationale. It's this, it's that, it's the Fed. The economy is not that bad. No. It really is that bad when 6.4% of mortgages aren't being paid. I mean, we're talking like paper that is just the residual effects of that are going to be felt for a decade. It is that bad when Google slashes marketing budget by 50%. 50%. Okay. What do you think a marketing budget for a company like Google is, huh? A few $100 million? It's a drop in the bucket. Right? And they're cutting it by 50%. It's bad. If you remember back to 2008, NASCAR, okay, cars going around a track without advertising, that's the kind of thing we're staring down the face of. But at the same time, the marketplace isn't reacting. So again, I kind of feel like, I've got those bearish positions on. I'm ready, baby. Bring it. But at the same time, I'm hedging my upside, which brings me to the next point. So the Nasdaq, again, is down that 1%. By the way, right there, when I tell you the Nasdaq's only down the 1%, why do you think I'm talking about stocks like Microsoft? And I've built a short position in Microsoft, and I've built a short position inside of Intel, okay? And I got to tell you what, all right, I'm even warming up now to the idea of Apple. I don't care if they're going to continue their stock buyback, right? It's neither here nor there to me, okay? How much are they going to continue their stock buyback if the stock starts to drop below like 200? Okay, they'll throw the towel in there sooner or later. It's not exactly going to be, a popular topic that they're still doing their stock buybacks if the stock starts to get crushed. All right, with that, now we're going to move on a little bit. Okay, moving on in here. Okay, and to do so, we're just going to drop down. All right, here comes the Fed. So if you're aware, maybe unaware, there's a Fed meeting coming out this week. Now, there's, people are like, there's nothing else they can do. There is always something they can do. And I expect them, and again, this is completely my opinion, I expect they're going to hint towards, okay, a next bout of stimulus. Okay, and even more specifically, I think that the Fed may even use their rhetoric to threaten, okay, ETF products. And I call it threaten. I'm a trader. I don't want the Fed involved in my business. I just don't. Okay, I don't want them to come out here and buy ETFs. But I'll remind everybody, they buy ETFs in Japan, and Japan is still wildly volatile. By the way, it's done nothing good for the Japanese economy. Okay, so I expect that the Fed's going to hint towards the next bout of stimulus, and I think that they're actually going to be questioned specifically during, okay, the actual conference. And again, every single time Jerome Powell, when the Fed has a meeting, they now do effectively a conference thereafter. Okay, so the Fed, though, at this point, in my assumption, they've got nothing but rhetoric. They're going to threaten the ETFs. Okay, and the bigger question, and this is not going to happen overnight, but my bearish tone inside of the marketplace, where it really comes from. It's not about the fact that, all the data is so negative over here. It comes from the fact that, okay, I'm of the belief, and again, strictly my opinion, that the markets will turn on the Fed. I'm not asking a question in here. I'm telling you, I think that the market eventually will turn on the Fed, and they're going to say, you know what? These monkeys are not going to save us, because in the end, it's about services, okay, and it's about economic output. It doesn't matter if you give everybody $2,000 a week and let them sit at home drooling on themselves. Sooner or later, okay, that crap doesn't work because there's no economic output. And this summer, we unfortunately may find out what that actually means. So at that point, when I say I think the market's possibly going to turn to the Fed, because they've done that again in every case where they've come out and bought ETFs, and the Fed has tried to stimulate in the face of adversity, all right, in other central banks. And again, I like to use Japan as the petri dish for that. It hasn't been very effective, which then brings me to the next point. Okay, you kind of feel right now, and I don't mind saying this. Okay, in this particular account, I think I've got like $700,000 that I'm trying to allocate. All right, in multiple accounts over here, and I've got accounts at other brokerage firms as well. And I'm like, I want to put that capital to work. Okay, do you buy now? Well, I just told you already, I'm short Delta. So, okay. The one thing that bothers me right now is, people are like, yeah, you know what? There's this feeling, okay, that you got to get in. You just saw a crisis, the crisis unfolded, and you kind of feel like you got to get back in before it just jumps to new highs. Like, I get that, okay, but what you have to look at on your proverbial hindsight is the fact that the volatility is still extraordinarily high. With a 36 VIX, that still means there's some serious crap going on. Right now, we can't even read the bonds, so you don't really know what risk is at, because, yeah, you've got the volatility, but you don't know where the bonds are at. You just don't know where the bonds are at because no one wants to trade the bonds right now. That's worrisome to me unto itself. You have a marketplace, okay, and arguably, okay, the biggest marketplace in the entire financial world, right? The bonds. And they're locked up right now and nobody wants to trade them. Okay, that's not a good thing. That's not, that's a problem. That ain't a solution that the Fed ultimately threw at us. And, with that, the correlations are really, really high. So as I'm talking about this, do I jump in? Do I buy? The correlations for me, forget that. Okay. It doesn't matter right now really what you buy, okay, or what you sell. When the market starts to move again, and it's been in that really tight channel, right? But when the market starts to move again, it's going to move the entire basket along with it. And you better be aware of that, because in this marketplace, you're like, it'll be safer over here. No, it won't. It doesn't matter who you are and where you are. There is no safer when the correlations, okay, to the upside are, look at, there's like 90 stocks in the S&P 100. You're like, it's not safe. Okay, it's just not safe. The other thing that's starting to really kind of grab me is private equity. They're throwing capital at distressed firms. A couple of weeks ago, I was talking about like Cheesecake Factory. They can't even pay their rent, but they've had private equity come in and throw capital in them. In fact, tons of these firms that have actually taken some of the bailouts, they're like, you know what? We'll give the bailout back. Because a private equity company. The private equity companies don't necessarily assume that these are brilliant, traders. Private equity seems to be throwing money, and I think they're early, really early. Okay. Are markets in denial or immune because of backstops? Like everybody, again, thinks that the Fed is just going to come in backstop, backstop, backstop. Okay. You're going to understand real soon, I believe, how big the marketplace is. That not even the Fed is going to have. They have the element of control. Okay. And that's really it. So this week, people are like, well, you should talk about this company and that company. What is there to talk about? All right. There are massive earnings coming out. Microsoft has earnings. Okay. We talk about companies like Apple. Yeah. Earnings. Okay. We've got what? Microsoft, Apple, Facebook. All right. Earnings coming out this next week. Amazon. Earnings coming out. All-time high. Speaking of Amazon, up some 27%. Okay. Google. Now, why I actually am mentioning Google again, Google is just down negligibly on the year. But I kind of question, why did they come out with that information about cutting, their marketing budget when they have earnings coming out next week? Ooh, they really wanted to get that news out over there. So we have earnings coming out. Okay, we have private equity firms throwing capital at distressed firms, and none of it seems to really resonate when you start looking at the amount of economic damage being done. And it's a big picture. And that's why I say, our market's approaching a breaking point. Yeah, I believe they absolutely are. I wouldn't be surprised to see the initial move. And I'm just throwing this out there because I don't want you to say, he's right, he's wrong. Okay. I wouldn't be surprised at all to see the initial move jerk higher and then pull us back in. I think you got to be really careful this week because we're coming into where earnings, they didn't matter the last 2 weeks. Nobody really cared about the bank earnings, right? They really didn't. The banks are like, yeah, we knew those were going to be bad. Nobody really cared about this past week's earnings. Clearly, Intel said some horribly negative things, like they're really far behind on projects. Apparently, you cannot build the next generation computer chips from your living room with ice cream. Ice cream and a pizza does not build chips. Anyway, Intel pretty much said that on their call. So it's bothersome. Correlations are high. The volatility is still there, but we're actually very, very tight channel. Expect this next week to be a pivotal week, which then really resonates with me. Last week, we had about $111 expected move. In fact, let me actually pull up the SPX in here, take you right to it. So this past week in trade, there's a $111 move. Now, that means up or down, right? So when I say $111 move, that's not one side, that's $111 higher, or $111 lower. Now, the actual move was $37. So this week really was marginally just a tiny bit lower. I mean, $37 in the midst of a $111 move is nothing. But if we bring up the QQQ and you actually come over to auto expected moves, the Qs also finished pretty much at par with where they started the week, right? So the expected move, though, next week, and this is yet to be drawn on your screen, so I haven't actually drawn the expected move for next week on the screen because, quite frankly, it's just now settling out, and be aware of this. So next week, we have an expiration on a Monday. We have an expiration on a Wednesday. We have a Thursday expiration because it's end of month, and we have a Friday expiration. They actually jumped up this expected move right into the close. So we're looking closer to about a $95 move right before they closed it, though. We were closer to an $85 expected move. Nevertheless, we're just shy of about a $100 expected move in the next week of trade. And again, remember that 11 out of the last 15 weeks have seen moves outside of expected. Again, from my perspective, we are wound up like a top. We are ready to rip at this point. And we have just enough fuel this next week to do just that. The Fed, the earnings announcements, and the earnings, frankly, I haven't been trading earnings this particular quarter. I don't like what I'm seeing in here. The moves are not what you would necessarily believe. There's very little edge around the earnings. Nevertheless, from the likes of Apple, Google, Amazon, and most of them are coming out within 24 to 48 hours of one another. We do have the makings of a market moving event. At this point, you got to get those positions on. If you're comfortable with the delta risk, you're going to be just fine. But if again, you look at my position, I'm negative delta. And I'll talk about my position early on in the week. I'm negative delta, which means I believe the marketplace is going to head back down. But at the same time, I'm covering my backside and looking for that explosion to the upside, okay? And I'm doing that by using ratio back spreads for a small credit. So if we go up, it's not going to hurt me, okay? If we go down, we're going to see great degrees of profitability. A lot to think about, again, in this weekend's update. Our markets approaching a breaking point. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.